Hello everyone, in this video our group will present about pension fund. Firstly, I would like to introduce myself. My name is Muhammad Syafiq Izzah bin Abdullah and this is our group member which is Nurul Fahana binti Saibi, Hani Amira Shalin binti Muhammad Nur Azman and lastly Intan Nurdayana binti Sabri Rizal. So let's move to our first section which is the review on the selection institution. So, our group has chosen Employees Provident Fund (EPF) for our discussion. So, let's see the introduction of Employees Provident Fund. The Malaysian EPF is a compulsory pension scheme that established in 1951. EPF helped the Malaysian workforce to save their retirement in according to the Employees Provident Fund Act 1991. The EPF provides compulsory retirement, saving and contribution for all Malaysian citizens and permanent residents who are working in Malaysia. As defined in the EPF Act 1991, employee means a person who is employed under a contract of service. However, if they reach the age of 75, they will no longer considered as an employee under the EPF Act. The objective of Employee Provident Fund is to ensure that all the employees in Malaysia are financially secure after their retirement. In addition, as a member, they are eligible to not only enjoy annual dividend on their retirement saving, but there are many withdrawal options and benefits that come will be as a EPF member based on term and condition. So let's move to the dividend. The EPF declare an annual dividend on fund of deposit depend on their performance that calculated on influence based on the full distribution of net EPF revenue depend on the return on investment that based on the asset allocation. Legally, EPF is only obligated to provide 2.5% dividend as per section 27 of the Employees Provident Fund Act 1991. However, EPF is not investment instrument. They claim that the lower dividend is the result of its decision to invest in low-risk fixed revenue instrument, which produce lower return but maintain the principal value of its member contribution. This is because EPF aims to provide a stable financial security for its members. As a retirement plan, money accumulated in EPF saving can only be withdrawal based on term and condition. Generally, members who reach 50 years old, they may withdraw only 30% of their EPF. However, members who are 55 years old or older may withdraw all their EPF. When a member dies before reach the predetermined age, the EPF fund will withdraw in favor of nominated individual. However, members who are above 55 years old can choose not to withdraw EPF saving immediately and withdraw later. Now I will pass this presentation to our next presenter.
Next is overview the product and services offered and the regulator structure. Account 1. This is the main account for your retirement needs. Money from this account cannot only be taken out upon retirement. In other words, cannot be completely removed before 55 years old. Account 2. The savings in Account 2 are intended to help us prepare when we want to retire. Therefore, withdrawal are allowed for purposes such as make an advance payment for first home purchase, second, settlement of housing loan balance for first home, third, financing the education of ourselves and our children, third, cover the medical costs of ourselves and our children, and the last one is performing Hajj, effective 1 January 2013. Account Emas, effective 1 January 2017. Account Emas will be introduced as a second retirement nest egg for members working beyond age 55. For those who continue working after the age of 55 years, EPF contribution from members and their employer will automatically go to account emas. Service for KWSP or remuneration in money due to an employee under his contract of service or apprenticeship, whether it was agreed to be paid monthly, weekly, daily or otherwise. Among the payments that are liable for EPF contribution, first, salary, payment for unutilized annual or medical leave, bonus, allowance, commission, incentive, arrears of wages for maternity leave. Regulation: Employees Provident Fund Act 1991, an act to provide for the law relating to a scheme of saving for employees' retirement and the management of the saving for the retirement purpose and for matters incidental thereto.
Next, I will present about the issue and risk in selected industry that we choose, which is EPF. The issue in the EPF is about the issue of insufficient retirement savings. And as a retirement plan, money accumulated in an EPF saving can only be withdrawn when members reach 50 years old, during which they may withdraw only 30% of their EPF. But when the member dies beforehand, the EPF fund is withdrawn in favor of a nominated individual, according to Yon B. 2020, page 17. Through the COVID-19 pandemic into the fray, and Malaysians are suddenly discovering that their retirement funds are insufficient. It is because the majority of employee provident fund EPF members are now facing a challenge of falling into old age poverty as COVID-19 related withdrawals have caused insufficient saving to live up a retirement life. According to the Employee Provident Fund EPF, current EPF savings for most Malaysians are barely enough for a decent life after retirement. In fact, statistics indicate that 70% of Malaysians outlive retirement savings, that those who withdrew their funds at age 55 used up their savings less than a decade after retiring. This will not only be detrimental to individual livelihood, but the socio-economic landscape of the country will also be affected. Next, the EPF also faces the investment risk of the Employees Provident Fund. It is because a Provident Fund arrangement defines contribution as mandatory and the investment decision is exercised by the fund, but the contributor bears the risk. The government has addressed this issue by guaranteeing a minimum return of 2.5% and by mandating the portfolio in which the funds can be invested. This need not produce an optimal arrangement. In addition, restriction on international diversification and for investment in domestic assets for doing business with domestically controlled companies or banks that can increase risk exposure or weaken risk control. This is a problem in Malaysia to the extent that the government's development goals constrains EPF investment choice. As a result, existing regulation and underdeveloped financial market, EPF is not able to invest on a portfolio basis.
Next is the recommend solution to improve the EPF. Firstly, the solution is increasing awareness to citizens the benefits and function of EPF in their life through, which means by harnesses a wider media universe such as social media, digital media and traditional mass media to safeguard member retirement fund and to spread to Malaysians the necessity of financial literacy as the proof of their golden years. And for the staff portal, informative email, casual talk session must be more cared to keep them updated with the latest event and policy to provide assurance to all the members and the public on the rapid transformation that the EPF is undertaking. Next, the solution is conduct public consultation to seek input for SIM enhancement, which is online survey. The survey must be done to help EPF members achieve a better future while at the same time safeguarding their savings, delivering excellent services and seeking more opinion on improvement feedback to gather as much input as possible to help develop, improve and potentially redesign the EPF SIM in the future. As Nur Hisham said, we last conduct a survey in 2015 and it was the largest ever public consultation carried out in Malaysia. How important the public feedback is as the response were the basis of subsequent change and improvement we made. Lastly, one of the solutions that they can do to make an improvement is a regular survey on retirement and health. Most of the members can withdraw their money in the 50 until 16 age range, so the industry can help make regular health check to make sure the member is still healthy. If they is around that age, there can be an exception to withdraw their money in any issue to avoid that they did not have any unsatisfied feeling their money can be withdrawn when they save a lot of their money in this industry. If this exception being accepted, it can also help to relieve their burden on any debt that they have, so they more believe in this industry.
In conclusion, Employee Provident Fund is a mandatory pension program for all Malaysian workers. EPF assists Malaysian workers in saving for retirement based on Employee Provident Fund Act 1991. EPF can be used as another alternative to employees in generate a fund that will be used after the retirement from work. This is because the contribution made on the regular basis on every month will make the fundraising can be done consistently. Not only that, employees can expand their existing fund with the annual dividend that declared by the EPF. Even though the amount of the dividend is small number, but as long as it gives an increase, it will be good thing for the workers. This is a very positive thing to them as it can help to fulfill the need of the employee. So that's all from us. Thank you.